Have you ever wondered why stock prices of companies like Apple, Tesla, or Amazon change every single second? Not every hour, not every day, but literally every few seconds. And no, there is no secret group controlling it. Backhand index pointing right. The truth is much simpler, and much more interesting. The stock market is basically a massive online auction. On one side, you have buyers who want to buy stocks at the lowest possible price. On the other side, you have sellers who want to sell at the highest possible price. And every second, these two groups are fighting to agree on a price. If Elon Musk announces new car technology or strong demand, more buyers come, price goes up. If there is production delay or negative news, sellers increase, price goes down. Backhand index pointing right. Simple idea, more demand equals price up, more supply equals price down. Now behind the scenes, there is something called the order book. Think of it as a live scoreboard. Green side equals buyers. Red side equals sellers. Apple stock, buyers, $190, $191, $192. Sellers, $193, $194, $195. If someone agrees at $193, trade happens that becomes market price. Backhand index pointing right. Important, this is not fixed value, just last agreed deal. Stock prices move fast because new information keeps coming. Amazon earnings report, strong profit, investors buy, price jumps. Weak forecast, investors sell, price drops. Backhand index pointing right. Even small news can move billions in value. If Apple announces new iPhone, stock reacts instantly. Now here's the most important part. Stock market is not just numbers, it is emotions. Fear selling. Greed buying. Hope holding. Netflix stock, if subscribers drop, people panic, selling starts, price falls. If subscribers grow, excitement, buying increases, price rises. Backhand index pointing right. Same company, different emotions equals different price movement. Now every company has something called intrinsic value. Backhand index pointing right. It means the real worth of a company based on earnings, profit, assets, what it owns. Debt, what it owes, future growth potential. For example, Coca-Cola, stable business, steady profit every year. Backhand index pointing right, so its value is stable and predictable. Tesla, future growth expectations, innovation-based company. Backhand index pointing right, so its value keeps changing with expectations. Simple idea, intrinsic value equals what the company is actually worth. Market price equals what people are willing to pay today. Sometimes stock price is higher or lower than real value. Tesla, during hype price goes too high. During fear price falls too much. Backhand index pointing right because market reacts to emotions, not just facts. Stock market does not price today, it prices the future. Amazon, even if current profit is small, investors buy because they believe future cloud business will grow. Tech companies often rise on future potential, not current earnings. Interest rates also affect stock prices. When interest rates are low, loans are cheap, businesses expand easily. Backhand index pointing right, stock prices go up. For example, in 2020 to 2022 low interest rate stock market boom. When interest rates rise, backhand index pointing right, investors move money to safer options, stocks fall. Inflation means prices of goods go up. When costs increase, companies earn less profit. Backhand index pointing right, stock prices may go down. Retail companies like Walmart feel pressure when costs rise. Big global events also move markets, wars, oil prices, government policies. Oil stocks rise when global conflict affects supply. So now you understand, stock prices are not random. They are a combination of backhand index pointing right, buyers and sellers, backhand index pointing right, human emotions, backhand index pointing right, intrinsic value, backhand index pointing right, interest rates, backhand index pointing right, inflation, backhand index pointing right future expectations, backhand index pointing right global events. So next time you see Apple, Tesla, or Amazon moving, remember, backhand index pointing right, it is not magic. Backhand index pointing right, it is human behavior reacting to information every second. If you found this helpful, subscribe to our channel for smarter investing insights.